Okay, so a very warm welcome from me and the FP Markets team. Thank you all for taking the time out of your day to be with us. So for those of you who don't know me, my name is Aaron Hill, and I'm one of the market analysts here at FP Markets. I've been involved in the financial market since about 2010, and in terms of credentials, I've completed CFTe levels 1 and 2, and enrolled on level 3 earlier this year. I also recently received the CFTe qualification from the International Federation of Technical Analysts in 2020. Guys, if you would be so kind as to just let me know that I'm coming across loud and clear, and the welcome slide is visible. That would be fantastic. As with all our webinars, please feel free to highlight any technical issues during the presentation, and the support team will try and get things up and running for you. Okay, guys, just let me know everything's okay. Excellent. Okay. Thank you, guys. Excellent. Okay, so look, for the following presentation. Okay. So for the following presentation, the focus is on margin and leverage, and is ultimately aimed at beginners. But I feel during my preparation, I may have overstepped the beginner mark a touch. But I'll try to simplify things as much as possible. As I understand, margin and leverage can be a tricky concept to grasp. Please be warned, there will be some moderate calculations shown here, so feel free to fall asleep if you must. However, as I said, although I'm very far from being a mathematician, I will try my best to simplify things. I'm assuming most of us here trade on margin, that is, use leverage. So can I just ask you guys, how many of us here believe they understand what leverage and margin is? Please just go ahead and type any responses in the chat box. And also, do you guys understand that there is a clear link between margin and leverage? We've got someone, guys, can you just confirm once more? Sorry, am I coming across loud and clear, because we have an attendee saying there's no sound? I can hear you. Okay. Okay, I'm not sure. That might be on your side then, from the attendee saying that they can't hear me, because the majority are saying they can. I'm really sorry about that. Okay. Okay, look, guys, before I go ahead and kick things off, let me just quickly run through the disclaimer on screen. As usual, the disclaimer informs attendees that information presented in this presentation is intended for general advice only, and none of it should be relied upon as personal advice. FP Markets do not take into account your investment objectives, financial situation, or particular needs. As usual, this is basically to say what I talk about in this webinar should not be considered as investment advice, and you should always do your own research with everything in trading and investing. Okay, so as for today's agenda, we'll first be looking at what margin and leverage is. This is basically an outline of the two concepts. We'll then look at how to calculate leverage, in particular margin, and then swiftly move on to the MT4 trading terminal and its features. You'll be surprised how many traders do not understand the terminal's functions regarding margin. Therefore, this should be especially helpful for newer traders present. I'll then round things off with an introduction to what a margin call is, and highlight a couple of points on how to prevent one from occurring, followed by any questions. Look, guys, if I'm unable to answer all questions, or you're unclear on anything today, please go ahead and email me and the research team at marketanalyst@fpmarkets.com, and we'll get back to you as soon as possible. Also, as always, if you have a topic you wish us to cover in future presentations, send across your ideas and the team will look at putting something together. And guys, please do remember to, we've just pinged our email in the chat box for you guys. So look, please do remember a recording of the webinar will be available through the FP Markets website or FPM's YouTube channel. Support will also send out an email after the webinar ends with instructions on how to access the recording. Okay, so on to the first topic of the session, an intro to margin and leverage. Just give me a second, guys. Leverage. Okay. Just checking everyone can still hear me. Excellent. Okay. So look, now I've got a truckload of information to get through today, as I really want newer traders to, leave with a clearer understanding. This it may seem overwhelming at the time of this presentation, but I encourage you to watch the recording a couple of times to help solidify your understanding. So look, one reason leverage is, is so confusing for new traders is it's frequently explained in, in somewhat misleading ways. I think many educators try to simplify the concept, but unfortunately, by doing so, it appears to cause more confusion. Hopefully this presentation does not cause further confusion. The aim is to ultimately to help newer traders understand the true meaning of what margin and leverage is, but it might also help clear up any confusions more experienced traders have picked up along the way through erroneous content. So let's kick things off with the basics. Margin and leverage are closely related topics. So look, higher leverage equals lower initial margin, and lower leverage equals higher initial margin. Don't worry, guys. This should make sense as we move forward. Look, so traders and investors employ margin to generate leverage. Leverage, for the purposes of trading, is basically the ability to put on a position larger than your available funds. So your account equity. So look, in the case of Forex, your broker allows you to use leverage by letting you only put a small percentage of the position size, put up a small percentage of the position size, I should say, and this is what's referred to as initial margin. Think of this as a deposit to trade, which, assuming risk is controlled by the trader, will be returned once the trade is closed or liquidated. Just click over to the next slide. So look, margin, as I just said, is expressed as a percentage of the position's notional value. So when I say notional value, I'm referring to the position size, 10,000 units or 100,000 units, for example. Margin is a portion of your account that is held by your Forex broker to ensure you have the means to cover any potential losses. Let me just say this one more time because it is incredibly important to understand. Margin is the portion of your account that is held by your Forex broker to ensure you have the means to cover any potential losses. Now, let me just say that digging into your margin level is not a place a trader wants to be, a move which is commonly thought as margin call territory. So look, the margin held by your broker is called an initial margin or used margin, and is it's taken away from free margin, which represents the available funds to trade. Now look, guys, as I said, please don't fret. I know I've thrown quite a lot of terms at you here already, but I will go over these terms in more detail later in the presentation. So look, once again, margin is, once margin is in place, the trader will then have access to what's known as leverage, which is a fixed ratio provided by your broker. Now, it's important to understand that leverage will not change. It does not change. it's a fixed ratio. It's your position size in units that changes. Leverage will not change unless you physically do so through your broker's client portal. So look, with leverage, as I said a minute ago, it represents the ability to, just excuse me guys, 1 second. So look, as I said, leverage represents the ability to put on a position larger than your available funds. Therefore, greater returns are possible when employing leverage. Although most of us don't like to, we also have to take into account that there's also increased risk of larger losses when using leverage. Each broker has a maximum allowable leverage, as I'm sure most of us here already know. For example, 50 to 1, 100 to 1, and 500 to 1. FP markets offer leverage of up to 500 to 1 on their pro account. Though as a retail account, they have a leverage facility of 30 to 1 due to the recent product intervention from the Australian Securities and Investment Commission. Just give me a second. So look, now, this is where it starts to get interesting. Is leverage a loan? Now, a common misconception about trading with leverage is that the leverage a trader receives is a loan in CFDs. I guess I can see why many traders believe it to be a loan, largely due to most educators pumping this out as fact. The broker, for FX spot trading that is not lending you anything. There is no loan, period. Let me just repeat that. Leverage in retail FX spot trading is not a loan. I cannot tell you how many websites state that traders are being loaned money to gain additional exposure. This, of course, is unlike, share dealing, where you're trading in physical shares. So look, when purchasing shares outright, that is if you want to say buy $10,000 worth of Facebook, Apple, or Google, for example, you'll need $10,000 in your account plus commissions. A margin facility is actually also available with in the stock market, but here you actually borrow. You do actually borrow from your broker in exchange for, I think it's interest paid on the securities. So typically traders are able to borrow, I think it's 50% of the stock's purchase price, nothing compared to what you receive with FX, of course. So look, spot trading Forex is unique. For one thing, in spot FX, the contract you are entering into is not a purchase of physical currency as you would do so in share dealing, and it's not exactly a futures contract either. It's a rolling spot contract with your broker, rolled each day at 5 p.m. Eastern Standard Time, if of course you hold trades overnight. The next point may surprise some of you guys here today, but look, when retail traders take a position in the FX market, they do not buy or sell anything. They simply form a contract with their broker where they believe the next move in the market will be for speculation purposes. This can be confusing, as most market analysts, including me actually, refers to going long as buying a currency pair and going short as selling. Just remember though, you as a retail trader essentially set a contract on the direction of a currency pair. You are not buying euros and selling USDs, period. You are only setting contracts with your broker. If you understand this, you'll understand why leverage is not a loan in the FX retail arena. So look, leverage trading is done as far as I know, only at retail level. That is between you and your retail spot FX broker. So at the higher level, think the interbank market, the trading between large commercial banks. These are unleveraged cash transactions. Generally, I think it's in the amount between $5 million to $100 million per transaction. Here, banks, I believe, actually exchange cash. So look, I guess I could also say that leverage trading is generally the route most retail FX traders take. if trading without leverage, you would require a significant account in order to make it worthwhile, and would not be, feasible for many of us traders. So look, think about it. You would need $10,000 to trade just one mini lot, and $100,000 to trade just one standard lot. Although there are retail traders who trade at this level, account size, the majority work with account equity of between, I think, 1,000 to about $20,000, I would say. The next point is regarding employing leverage in the derivatives market. So employing leverage in the derivatives market, such as options, futures, contracts for differences, and FX, are based on contracts. A derivative, how can I explain this without confusing? So look, a derivative is something that derives its value from an underlying market. With CFDs, traders set contracts based on the underlying asset and cannot take delivery of that underlying asset. This is important to understand, as the contract is in place to speculate on the difference of the price between two parties. But with futures and options contracts, which are also derivatives, some futures and options brokers do allow investors to take delivery, though as far as I know, this is rarely done. Excuse me, guys. Just want to check if there's any questions. No? Okay, excellent. Okay, look, so how do we calculate margin? So as I briefly touched on already, margin is a percentage of your equity put aside by your broker to execute trades with increased exposure. This is to cover the possibility of loss in your account, as I already touched on earlier. So margin is not a cost or a fee. It is essentially a deposit to trade. As far as your broker is concerned, your margin requirement will be calculated in your account currency. Ultimately, there are a couple of different calculations traders must be aware of when manually calculating margin. For those of you like me, though, who prefer the ease of calculators, FP has a dedicated FX calculator available. Just give me a second, guys, and I'll throw this link into the chat box so you can access it. Just give me a second. Okay. However, though, while a calculator is handy, it's always good to understand the dynamics behind the calculation. So right now, brace yourself. I'm going to run through some of the calculations. Right. If your account currency is the same as the quote currency of the currency pair traded, you must multiply the position value by the current price of the pair traded and multiply this value by the margin percentage, which in this case is 1%. As we're assuming in this example, the account has a leverage of 100 to 1. So how do we know our margin is 1%? So look, we simply divide the leverage ratio. So in this case, 1 divided by 100. For 50 to 1 leverage, it would therefore be 2% or 0.02. Just to confirm, guys, for the quote currency, that is the second currency in the currency pair, and just down here, the base currency would be the first currency in the currency pair. We have done previous webinars on this, so feel free to check those out. So look, as an example, trading Euro Aussie dollar with an account denominated in Aussie dollar with one standard lot requires 1,630 Aussie dollars margin to execute a trade. And that is, so 100,000 position value multiplied by the Euro Aussie dollar price, 63.09, multiplied again by 0.01 or 1%. If you traded just one mini lot, you simply swap the 100,000 value here with 10,000. and you'll get, I think it's approximately around 163 Aussie dollars in margin. So look, now what about if the account currency is denominated in the same currency as the base currency of the currency pair traded? This margin percentage requirement is simply found by dividing your leverage ratio. For instance, similar to the above here, an account set at 100-to-1 leverage equates to a 1% margin. Remember, so we divide 1 by 100. So trading one standard lot, 100,000 units, equals $1,000 margin, and trading one mini lot at 10,000 units equals $100 margin. And finally, if your account currency is different to the currency pair traded, so look, for an account denominated in Aussie dollars, though trading euro dollar, for example, we simply multiply the position value, 100,000 units for a standard lot in this case, by the current euro Aussie dollar price. Let's say 63.16, and then multiply this value by the margin percentage, 1% in this case. So to trade euro dollar with an account denominated in Aussie dollar at the current price, you would need 1,631 Aussie dollars margin, or 100,000 multiplied by 63.16, one spot 63.16 should I say, again multiplied by 0.01 or 1%. Look, guys, I'm probably bored about 90% of you here and likely confused just as much, but have a play around with it. As I said, there will be a recording, and I would advise watching this a couple of times so it really sinks in. The calculation will then become straightforward. Again, however, most of us will never manually calculate this, I believe. Most will look at the online calculators that's provided. Okay. Understanding the terminology. As I already said earlier in the presentation, it may surprise you that many traders only understand the bare bones of their trading terminal. If you're going to take trading seriously, you must understand the trading terminal's functions. It's not just about trend lines, support and resistance, supply and demand, the RSI. You really need to understand all of the trading terminal's functions. Hopefully by following along on the slide, the pound-dollar long trade, newer traders here will leave with more understanding of margin functions featured on the trading terminal. So first up, we have the order number. This is self-explanatory, and I won't waste time on this, as it's simply the order number of an individual trade. Up next is the balance. And this is, well, the balance of our account, the funds we have in a trading account. And again, it's pretty much self-explanatory. This is the current balance in the trading account. For my demo account, I have a little under 100,000 GBP, pounds. So look, moving to the right, we have equity. Now, this will be the same as your account balance. When you have no active trades. Once trades are executed, however, the equity balance, as you can see here, will fluctuate in accordance with the trades you have open. So in the example on the slide, our equity currently stands at £99,765. This is £25.47 below the balance in our account and the loss to the account, as shown by the profit and loss value over to the right-hand side. Next up, we have margin. Now, this is where I think a few of you guys may get confused. This is the deposit taken by your broker at the beginning of your trade. As you can see in this example, it is £1,000. This is because, as we just spoke about just a minute ago with the calculations, my account is in GBP and the pair traded is the pound US dollar. And the account has a leverage of 100 to 1. So we know initial margin is 1% or £1,000 of the notional value of the position. So this value, used margin, is will not fluctuate during the trade. As you can see on the terminal, used margin is simply equity minus free margin. So we have the free margin here, equity minus free margin equals margin used. Now look guys, as long as the equity level here remains above your margin level, the account will not hit the broker's stop out level. This is something we'll look at shortly. So please don't fret too much. Also, as an aside, you can check your leverage settings from your MT4 terminal. To check the leverage of your account on MT4, select the Navigator tab, Control N in your MT4 trading platform, and click Accounts. By hovering over the account number, you will see the base currency and the of the account and the leverage ratio you have chosen. But as I said earlier in the presentation, you can go into your client portal and modify your leverage if you need. Okay, so next up we have where are we? Free margin. Okay. This currently stands at £98,765. Now, free margin is equity minus used margin. Free margin is the amount of account equity that is currently not being used to maintain open positions. Essentially, it is the amount available in our account to open additional positions and the amount that our current position can move against us before we receive what's known as a margin call. As I think I already said, as long as our equity level, this value here, remains above this value here, our margin, we will not receive a margin call. Again, I will touch on this in just a minute. So look, and finally we have our margin level percentage. So I think the margin level is simply a percentage value based on the amount of equity versus used margin. Margin level, allows you to know how much of your funds are available for new trades. Okay. Okay, onto the dreaded margin call. Just give me 1 second, guys. Right, so margin call. What is a margin call in trading? Now, look, a margin call occurs when a trading account no longer has any free margin. You'll remember from the previous slide, free margin. I'll just pin back to my previous slides real quick. You remember free margin is here. That's the equity minus our margin, used margin equals free margin. All right. Okay. So remember, as I said, as long as our equity level remains above margin, our used margin, we will not receive what's known as a margin call, which is a request from the broker to bring margin deposits up to initial margin level, also known as deposit margin, to keep existing positions open. Now, for FP markets, I'm 95% sure they do not physically call clients, and I'm pretty sure most brokers don't do that. I know the MetaTrader terminal will change color if equity drops below margin. I believe it's a red color. For FP's IRS platform, however, a margin call is implemented where I do believe they call clients. However, please do double check this with the support team if you're interested. What's really important to understand, though, is the broker's stopout level. So look, if equity drops, I'm almost repeating myself here because I really want this to come across and stick. So if equity drops beneath 100% of the initial margin, the used margin, I believe this is when your terminal turns a different color, red, I believe. And you run the risk of hitting the broker's stop out level. Now, a broker's stop out level is not widely discussed on the forums as far as I've seen. It's mainly margin call, margin call, margin call. As the name suggests, a stop out level, this is where positions are automatically closed to avoid the account going into negative territory where you could, God forbid, end up owing the broker. The stop out level for clients on FP markets is 50%. So what is this? Right, so FP markets work with a 50% stop out level, which means if equity falls below 500 pounds, should your initial margin be 1,000 pounds, FP markets automatically closes the first most losing position. So to help clarify, this liquidation happens because the trading account can no longer support open positions due to lack of margin. The stop out level is when the equity is lower than a specific percentage of your used margin. I know that's a bit of a mouthful. I do hope it's coming across clearly though. So we have our margin level, which is 100%. So this is when God forbid, if price hits this level, you have no more, you're touching your used margin level. So all your free margin is gone at this point. If you dip below this level, you're now into really, dare I say, dangerous territory, because you're in within touching distance of hitting the stop out level, which is when the broker begins to. So look, guys, imagine this is £1,000 here, my £1,000, my used margin here. All the free margin is gone, so we're down to this level. We jump below here, and now we're in negative territory. We're below 1,000, so we're at 750. And if we hit 500, if we creep below that just a tad, we're into we're going to start having positions closed out. So look, how can we help? How can we avoid a margin call? Or as I just explained, how can we avoid hitting the stop out level? Well, obviously, the first and foremost way to avoid hitting the broker's stop out level is to know what it is. It is scary how many traders do not understand its dynamics, yet insist on, trading with live money. For me, without understanding this, it's like driving a car without the correct training, right? It's only a matter of time before you crash or cause serious damage. So another obvious way to control risk, to avoid hitting the stop out level, is of course to use stops. This is obvious. Always use a stop loss order. They're in place to protect your account, hence the name protective stop loss order. I often see some traders advertising they don't use stops, they use mental stops, but that requires a truckload of discipline, because if price is hits your mental stop line, and you don't have the discipline to execute your position, you're heading for a world of hurt if price keeps declining on a long trade. So I would always recommend hard stops. Always recommend that. These two are really key, guys. So understanding what a broker's stop out level is, you must understand that. And let me just say that the different brokers operate with different stop out levels. As I said, FP markets work with 50%. Some other brokers might work with 20%, 30%, 70%. You'll have to look into that. I believe their support team will be able to help you with that. So as I said, these are the two really key things I would focus on to help avoid reaching the stop out level. Risk management should always be your main priority, not profits. I know this is easier said than done, But you should really focus on controlling your risk first and foremost. You know, I'm sure some of the traders here have read that you're a risk manager. Being a trader means you're a risk manager. And if you don't manage risk, irrespective of how good your trading strategy is, or the win percentage, the risk to reward, it really doesn't matter if you're not controlling your risk, because it only takes one trade to absolutely ruin months of gains. So risk management really is a key factor. So look, do not trade with excessive leverage. In other words, control your position size. Remember, the leverage ratio is fixed with your broker. This does not fluctuate. It's not a fluctuating value. Leverage does not fluctuate. Position size can be altered to suit your preferences. And this is where some traders go wrong. So look, trading a one standard lot position equals around, it's around $10 per pip. You have to ask yourself, are you comfortable with this? What about trading 5 standard lots, or 500,000 units of the base currency, which means each pip movement is now worth $50. We're then talking some very, very serious account fluctuations. Okay, guys, are there any questions? Actually, before I take any questions, let me just try to summarize what I've been trying to get across, as this will likely help clear any confusion, I hope. So look, for retail spot FX, remember that leverage is not alone. Anyone that tells you this is incorrect. Leverage is not alone in retail spot FX. This is not share dealing. We are not buying physical shares. We are trading in contracts. Derivatives. We are trading the derivatives market. Now, to further this understanding, let's assume we're trading. Let's assume, just for now, we're trading physical currencies. We have in other words, we trade unleveraged transactions, and we have relatively deep pockets. So let's imagine the euro dollar currently trades at, say, 120, and even 120, and we want to buy 100,000 euros. So as we're trading physical currencies, we have to deliver 120,000 USD to receive 100,000 euros, right? Now assume euro dollar rallies to 121. This is a 100 pip move, and now I want to take advantage of the euro advance. So I then can deliver my 100,000 euros to receive what will now be 121,000 US dollars, a 1K profit, right? Now the key here is trading on margin allows you to pay a small amount of the notional value, 100K in this example, to trade a 100,000 contract or one standard lot. So basically, you deposit margin to gain exposure to the same value you would have if you had physically traded currencies. I'll just repeat that, guys, because this is the key point of this presentation. You deposit margin to gain exposure to the same value you would have had if you physically traded the currencies. Remember, when retail traders take a position in the FX market, they do not buy or sell anything. They simply form a contract with a broker to trade the underlying price through derivatives, where they believe the next move in the market, in the FX market, will be. In FX, we do not trade the underlying market. We trade derivatives in the form of contracts based on the underlying market. Okay, let me just. Okay, topic is. Okay, we have some really cool questions. I love them. Just let me. Let me spin this round. I can't hear. What is the max leverage we have in FP markets? So the max leverage you can have on FP markets is 500 to 1, but that's with a pro account. Just go onto the FP markets website and search pro account, and that will provide you with the details. But with a retail account, due to the recent product intervention, you're only you're only allowed to have access to 30-to-1 leverage. Topic is so boring. Thank you very much. Okay, the next question. It's obvious you understand your stuff, but as a beginner, I require a course that runs a quiz to test my knowledge. Can you help? We're actually in the process of designing a course from beginner, intermediate to advanced, and we're also, I believe, we're also in the process of opening a portal where you can have access to analysts on a 24/5 basis. Yeah, so I hope that, and also with the education, with the educational part of the website, we will be running quizzes as well. So I hope that answers your question, Samson. Corporate account is 500-to-1, and the retail. Yes, you are right. Ashok, I think. Yeah, the corporate. I'm not sure about the corporate account actually. I'm not sure about the corporate account. You have to speak with the customer service for that. But I know a pro account is 500-to-1 and a retail account is 30-to-1. Can I understand leverage is the level of amount the broker lent to the retail trader for him to be able? No, look. So there's a question here. Can I understand leverage is the level of amount the broker lent a retail trader for him to be able to purchase a lot? So in this whole presentation, I've tried to emphasize the point. For retail spot FX, there is absolutely no loan. There is anyone that tells you this is incorrect. There is no loan in FX spot. For retail traders, there is no loan. We trade as retail traders. We trade derivatives in the form of contracts based on the underlying market. Okay, so there is no loan. What you do when you trade on margin, you deposit a small amount to gain additional exposure, as you would if you were trading physical currencies, as I explained just a minute ago. I can go over that if you require, just really quickly again, because I believe it was a really good example on the euro dollar. If that would help. I don't think we have any questions, so I might just go over that. Do you mean a pro account is 500-to-1, right? Yes, I do mean that. So a pro account has a leverage facility of 500-to-1, and yeah, a retail account, if you don't meet the requirements of the pro account, is 30-to-1. All right, just for Mr. FX that asked about if a broker lends clients money, I'll just go over this example once more as I have it written down. So look, the euro dollar, imagine it trades at 120, and we want to buy 100,000 euros. This is imagine we're trading physical currencies at this point. So we physically have the cash, and we physically want to exchange cash. So euro dollar trades at 120. We want to buy 100,000 euros. We therefore have to deliver 120,000 US dollars to receive 100,000 euros. Now, as I said, assume the euro dollar rallies to 121. This is a 100 pip move, and now I want to take advantage of the euro advance, because the euro has advanced against the US dollar. So I can then deliver my 100,000 euros and receive what will now be 121,000 US dollars, because we're trading 100,000 euros, right? So this is a 1K profit, the equivalent of $10 per pip. So look, now trading on margin allows you to pay a small amount, a very small amount of the notional value, so which is 100,000 in the example I just explained. So to trade a 100K contract or one standard lot, you basically deposit margin to gain exposure to the same value you would have if you had physically traded the currencies. It's really as simple as that. Once you understand these 2 points, you'll understand you're not being lent anything by the broker. There is no loan. There is absolutely no loan from the broker. It just doesn't make any feasible sense. The broker would go out of business. He doesn't have that much money. Brokers don't have that much money set aside to provide leverage. to loan out money. So look, let me just go over that again. So now trading on margin allows you to pay a small amount of the notional value. So as I said, 100,000 in this example to trade a $100,000 euros contract or one standard lot. So basically, you deposit margin to gain exposure to the same value you would have if you had the same as if you would have traded physical currencies. So it's key to remember that when retail traders take a position in the FX market, they do not buy or sell anything. There is no going long or going short. They simply form a contract. They simply form a contract with their broker. The retail traders form a contract with their broker to trade the underlying market price through derivatives, where they believe the next market move will be. I've just literally repeated myself word for word with that. I hope this helps, guys, because that is crucially important to understanding how leverage and margin really works. What is the advantage or benefit for the broker to give leverage to retail traders? Well, without leverage, you'd find it very, very difficult. As I explained earlier in the presentation, how many of us here trade with enough capital to execute a one standard lot? That's 100,000 of the base currency. So that's 100,000 US dollars, 100,000 euros. I'm pretty sure most of us here will not have that in our account. Even 10,000 euros or US dollars, that's only one mini lot. That's the equivalent of $1 per pip. So that's the reason brokers provide leverage. It's to enable retail traders like us to be able to participate in a market such as the FX. So we have another question. What does the contract contain? Edward, I'm not sure on the question. Can you please maybe expand the question a little bit? And we don't have any more questions, it seems. So guys, look, I hope I haven't confused you too much. I hope this has opened your eyes a little bit to leverage and margin. The leverage is not alone, expiry date, direction. So if you're talking about CFDs, Edward, there is no expiry date, really, because it's rolled every day. That's when you the swap rate. So it's rolled every single day at 5 p.m. So it effectively never expires. It's an ongoing contract. Hence why you can never take delivery on a CFD trade. When I say delivery, I mean, like in the options and futures markets, you can actually take delivery as some brokers allow this. As for direction, I assume you mean going long and short, right? That's up to the individual trader, how he wants to trade. We have another question. Can FP markets inform in advance before the margin call? If yes, at what level? Now, look, I'm not sure, so let me just repeat that question. Can FP markets inform in advance before the margin call? If yes, at what level? Now, I don't believe they inform in advance. What you'll see on your terminal, look, hopefully this will never happen to any of you guys because you should know what a stop out level is now. But if you reach your, I believe it's reach your margin level where you have no more free margin left, your terminal will turn red. And that is that's enough of a warning for me to know that something's wrong. So if you're down to your margin level, which is you got no free margin left, and you dip below that level, you're then in relatively close range of hitting your stop out level, which is when FP markets or any broker, depending on their stop out level percentage, will begin closing. I think it's the most losing trade. We have a question: what are spreads and what are swap charges? As this is look, you can find all that information out on the FP Markets education site about spreads and swap charges. But just quickly, a spread is the difference between the bid and the ask price. So the bid price is where you sell, where the retail trader sells, and the ask price is where the retail trader buys. The difference between the bid and ask is the spread. This can be a pip, this can be half a pip, and this can be a spot 1 pip. It can be really small. And tight spreads are obviously better for shorter term traders such as scalpers and things. As for swap charges, please do just go to the FP Markets website, and we have a really detailed article on that. Okay, guys, I don't think we have any more questions. Please tell me I haven't confused anyone here with this. I did warn you at the start. I was going to try and go into detail as much as I possibly could, so you could walk away with hopefully a deeper understanding. But guys, as I said, please do watch the recording, and any questions, please feel free to fire them across. So look, I think that's all we've got time for today. Look, I sincerely hope newer traders were able to walk away from this presentation, as I said, more knowledgeable. Look, if there are any specific topics you would like the team here to talk about, please be sure to send any suggestions. Send any suggestions to either support@fpmarkets.com or at marketanalyst@fpmarkets.com. Look, also make sure to register for the FP Markets Telegram channel to get instant updates. Brilliant, guys. Thank you. That's good. Yeah, please do. Look, we have some attendees saying they're going to get in touch with me for more questions or clarifications. I welcome that, because I understand this is a really tricky concept to grasp, but it shouldn't be. That's the annoying thing for me. It really shouldn't be that tricky to grasp, because if you go out and read another article on just pick 10 articles on leverage and margin in FX, I'm pretty sure 80% of them will say leverage is a loan and start talking about it as a loan, and that it's unbelievably confusing, and it just doesn't make any sense at all. As I said, leverage is not a loan, especially in FX, retail spot FX. Yeah, so look, I hope you could, as I said, I hope I've done a good enough job to highlight this point for you. Okay, on that note, thank you all so much for taking the time out of your day to attend this presentation. Have a great day, and I'll see you all again very soon. Thank you very much.